real estate, bonds, commodities, investment trusts, cryptocurrency, stocks, equities, assets, asset classes. What? Hi guys, and welcome back to my channel. The day has come when we finally are talking about investing. Yes, you heard that right. Can I get some amen in here? No? No one? Okay, let's move on. So what really is investing? Investing is act of allocating resources, usually money, in order to make some profit or income. In other words, it's making money work for you. You can invest in different asset classes. I'm using big words here. So what is an asset? An asset is a resource with economic value that a person, a company, or country owns or controls with expectation that it will provide some future benefit. So an example of that could be a house or an Apple share. With that, asset classes are groupings of investment that share similar characteristics and are subject to the same laws or regulations. Today, we will talk about 6 different asset classes, the differences between them, the characteristics of them, the benefits, and also the pitfalls. Before we even go there, why should you invest in the first place? Well, the first culprit is inflation. Inflation is the decrease of the buying power of your money. The average inflation rate is 2 to 2.5% every year. This means that on average, stuff in general costs 2 to 2.5% more every single year. A great example of this is coffee. In 1970s, a coffee in the United States cost 25 cents. In 2019, coffee in the United States cost on average $1.59. So if you have money sitting in your bank account, it's losing the value every single year. But Anya, I have a savings account. That's great, but savings account usually have a rate of 1%, and that is less than inflation rate that I mentioned earlier. Savings accounts are not the best, especially here in the UK. I mean, I haven't really crossed any account that would have a sensible rate, and if you are in the UK and you have a savings account that's around 2%, please hit me up and let me know, because I would love to know more about it. So if you like me and you don't like the idea of your money losing its value by sitting under the mattress or on your bank account, whatever you prefer, please stay with me so you can learn, and I encourage you to invest. We all need to remember that investing involves some degree of risk. Therefore, before we even start, there are 2 important things that we need to do. Number 1 is you need to budget. You need to know where your money is going. If you don't budget, they say that you can't improve what cannot be measured. That's why you should budget. And if you're completely new to this, please watch this video to learn how to budget and how to manage your money right. Second thing is, you need to have an emergency fund. Emergency fund is a pot of money where you have 3 to 6 months of expenses. So if anything happened and you lost your job tomorrow, you will be able to live from 3 to 6 months without any job. Obviously, the number of months may vary depending on you and your preferences. If you are very conservative, you may have 12 months of expenses covered. It all depends on you. However, I do recommend at least 3 months, okay? Now that we both have our budget sorted and our emergency fund, let's get to the fun bit. First, we have real estate. Let's say you buy a house for £120,000 and you rent it out. First way of making money is through the rent itself. Let's say you rent it out for £1,000 each month. That is passive income for you. Every single month, you get £1,000 in your pocket. In 1 year, you will get £12,000. And in 10 years, you will have £120,000. So the house will pay for itself. Second way of making money is through the value of the house itself. In developed countries, there's a tendency for houses to appreciate over the time. This means that the value of the houses increases. In the UK, historically, the houses double in price every 10 years. If you bought a house for £120,000, it will be now worth, after 10 years of renting it, £240,000. This is also known as capital gains. The downside to investing in real estate is, first, you need a lot of money. You need to put down a deposit, you need to get a mortgage, you need to find some people or agency to rent the house out for you. So that could be a hassle. So don't worry if you don't have enough money to buy a house, but you still want to get involved in real estate somehow. There is a solution. Number 2, we have investment trusts. Trusts are another type of pooled investments, with real estate investment trusts being the most popular ones. They're also known as REITs. REITs invest in commercial or residential properties and pay regular distributions to their investors from the rental income received from these properties. REITs trade on major stock exchanges, which means that they are highly liquid, unlike the physical houses. Number 3, we have commodities. Commodities are raw materials that range from metals, both precious and industrial, energy sources, oil and coal, and agricultural goods such as coffee and wheat. These are physical products and their price depends on scarcity. There are a few ways that you can invest in commodities. Firstly, we have exchange-traded commodities, ETCs. These track the performance of a commodity and can be bought and sold on a stock market, just like a normal share. Secondly, you can invest in companies that mine or produce the chosen commodity. Commodities have shown a strong performance during periods of high inflation and uncertainty. I remember back in 2020, when the stock market crashed, a lot of people turned to gold and bonds, which leads me to my next point. Bonds are also known as fixed income instruments. They are used by governments or companies to raise money by borrowing from investors like me and you. They are usually issued to raise money for a specific project. In return, the bond issuer promises to return the money to you with interest over a certain period of time. Usually it's every quarter. In the period of 1928 to 2010, bonds returned on average 5.28%. Whereas stocks returned 11.3% on average. Bonds are considered to be a safer investment than stocks, which leads me to number 5, equities, also known as stocks. When you own a stock, you own a piece of a company. Investing in individual stocks is considered risky because you're putting all eggs in one basket. So let's say you invest all your money into Tesla stock. One day it goes up, but then suddenly Elon tweets something and it goes crashing down. That's all your savings and money gone. But don't worry, there's a solution. You can diversify by investing in a lot of different companies, or you can invest in mutual funds, index funds, or ETFs. What are those? Well, don't worry, I got you covered. In my next video, I will break it all down, so stay tuned for that. It will be loaded with useful information, so you definitely don't want to miss that one out. Click the bell to be notified when I post that video. If you own a stock, you might get money through dividends. Dividends are payments that company makes to share profits with its stockholders. These are paid out usually every quarter. And we also have, again, capital gains, which are the profits from a sale of an asset. And last, but certainly not least, we have cryptocurrency. Cryptocurrencies are digital assets. You exchange real currency, like pounds or dollars, to purchase coins or tokens of a given cryptocurrency. There are many kinds of cryptocurrencies, with the Bitcoin being the most famous one. First huge benefit of them is that they are decentralized, which means that no government, no bank, no one decides how they are produced, where they are exchanged or how they are exchanged, and what their value is. Cryptocurrencies are built on top of blockchain technology. To put it simply, there's a network of computers that shares the same history of transactions, and each transaction has to be validated by the network. You can think of it as a really long receipt that keeps growing with every transaction. And you only can append new information. You cannot change or erase something that has already been appended. Cryptocurrencies are very volatile and there are a lot of unknowns surrounding them. Nonetheless, they are very exciting and interesting, at least for me. See, even my shirt dropped. I mean, that's what crypto does to us. Knowing all these asset classes, please let me know in the comments down below which asset classes you will be investing your money in and why. I would love to hear that. Remember that no one really knows how the market will look like in the future, so please be careful and only invest the money that you can afford to lose. Hey, before you go, subscribe to my channel to join me on a journey to financial independence and lifelong learning. Thanks, guys!